Welcome back. I'd like to address an issue that seems to be a highlight of the news in the last few days. First off, my heart goes out to all those people who are suffering because of the coronavirus. I constantly pray that the whole world can be healed from the virus and that the virus can once start to slow down and begin to recede so that we can be free and going back to work in particular. But what I'd like to talk about is the one piece that was in the news. If we go back to March 15th, you read in the news that the Federal Reserve cut the interest rates to between 0 and 0.25%. So that is what they call the federal funds rate. That is what the big banks, the Chase Manhattan and the Citibank level of banks can borrow from the Federal Reserve at. There's only a handful of banks in the world that can actually borrow straight from, actually in the United States, that can borrow straight from the Federal Reserve. At that point in time, they announced $700 billion that they would spend on what they call quantitative easing. On March 23rd, another announcement from the Fed came that they announced unlimited quantitative easing. And I noticed in an article just yesterday, which would be the 27th of March, that the Federal Reserve then said that their bank balance, that their balance of equities that they had purchased was now the largest that it had ever been before. So they are being aggressive in putting money into the economy. So what I wanted to discuss today really is, what is this term quantitative easing? What does it mean, and what does it mean to us as citizens of the United States? For one, it is an unconventional monetary policy. It was first practiced in 2008 when the mortgage crisis happened. And the only time it has had to be used is when the federal funds rate has had to drop to zero and they had no other levers in their arsenal to be able to manage or boost the economy. So the biggest challenge that the Federal Reserve had is they didn't have any more leeway. They couldn't make the interest rate negative. They couldn't pay other banks to borrow from them. That would be a bit absurd in most characterizations of it. So with the funds rate at zero, really the only way that they can do it is to aggressively expand the money supply. And literally that is what quantitative easing does. Let's look at 2008. 2008, the problem with the mortgage crisis was that people got to the point where, as interest rates on their mortgages, which were mostly adjustable rate mortgages, when they started resetting at the fifth year in or seventh year in, whatever your note said, those interest rates jumped so high that people began to struggle to pay their mortgages. And at an increasing rate, people began to default on those mortgages because people were given mortgages by walking in and say, yes, I earn money. Here's a mortgage. And it was literally so loose because of several different policies that had been pushed out into the economy, such by the Housing and Urban Development group in the federal government and so forth, that because they wanted people to have the joy of owning their own home, they lowered the regulations for banks to give home loans, and then they took those home loans, and of course in the secondary markets they packaged them and sold them, and they moved around the world actually to fund all of these mortgages. So what a mortgage company would do is they would go out and lend, and so they'd lend some money that they had, and then they would immediately turn around to a securities facility like Chase Manhattan or Lehman Brothers or other large banks that also dealt in securities to buy those mortgages, thus replenishing their supply of cash and allowing them to go then make more mortgages. So these mortgages were constantly packaged into secondary markets. Well, as the people started defaulting on these mortgages, all of the money kept draining out of the system, and all of these mortgage facilities, the securities that were packaged together to hold all these mortgages, began to fail. And as they began to fail, the market dried up to sell them. So here you are with a mortgage company that can no longer make mortgages because they can no longer sell the mortgages to the secondary market. And it's at that point that that whole market seized up, and the ability for mortgage companies to continue to loan seized up. Foreclosures increased, and away we went with the recession that shortly followed after 2008. Well, in that particular case, what happened is the Federal Reserve stepped in to begin buying those securitized mortgages so that the mortgage market could continue functioning somewhat, although at the same time they tightened up the requirements. And then we entered this long recessionary period where it was hard to continue and get mortgages, and we saw house values plummet for a period of time. So that was the history of 2008. Today, what we've got is an across the board. We don't have just one industry. We don't have just the mortgage industry that's a problem. We have trouble in the cruise line industries, the airline industries, the manufacturing industries that can't continue to function. We've got whole states that have had to close down all businesses. And when you close down a business, all their assets are just sitting there with certain amount of fixed costs and no income to cover it. So the situation is, for the longer that this goes, gets very, very bleak. And in order to make sure that these businesses don't just go out of business like all the mortgages and foreclosures happened in 2008, these businesses have to have some money to function. Individuals have to have money to function. And if they've been laid off from work and there's no money coming into the household, they file bankruptcy just like the mortgages were defaulted on. So it's a lot the same scenario in the respect that you have businesses failing and individuals and households that could fail over time. So today's focus for the Federal Reserve will be in buying treasury bonds and mortgage-backed securities, corporate bonds, municipal bonds, and asset-backed securities. Now, asset-backed securities, of course, are mortgages and loans on assets, that type of thing. But a mortgage is probably the easiest for all of us to understand. So they're going to continue doing that in order to put money out in the economy. Now, these businesses, we're all going to get back to business here pretty soon. Now, how does the Congress fit into this? Now, I've just talked about quantitative easing, and the effect of quantitative easing is to put more money into the economy, and they're pumping money very quickly. In other words, a lot of times you might hear them it be said that they're running the printing presses and printing more money. Well, that's the way that the Federal Reserve prints more money, is to buy, through quantitative easing, more and more securities off of the market. So thus they set them on the shelf in the Federal Reserve's book of business and put money in the economy to do some good out there. Because when money stops circulating, it drains everybody's pocketbooks. Because every time a person gets a paycheck, that $1 will tend to get spent about 13 times before it ends up in a savings account. So if you're not spending those dollars up front because somebody isn't earning a wage or somebody isn't cranking out business, it slowly just drains the money out of the system, and money just stops flowing in the business. So here's where we go. The challenges with this is that when you print money, you can inflate your currency. Inflation can be rampant if it's not watched very carefully, and hopefully the Federal Reserve will watch that very carefully. It can lead to a stagflation. In other words, you can have inflation but no growth. And what we're hoping for is that if there is some modest inflation, that there comes growth with it. That after this whole thing is done and we start getting back to work, that the money that is in the system will continue to be able to use to continue getting that flow of goods moving again. Another possible effect is that it'll devalue the currency. the challenge here is that it'll devalue the currency compared to what? If the United States were the only ones doing it, and believe me, the Federal Reserve has its counterparts in a lot of different countries, those other countries are also running the printing presses too to make sure that their economies stay on their feet. So the effect might be to devalue the currency, but compared to what? If the other countries are doing it too, they'll probably stay in parity the way they currently are. Now, how effective is this? We'll see both the quantitative easing and we'll see Congress sending out money. We'll see the Federal Reserve making sure that the Treasury can borrow enough so that the Congress and what they've approved with their $2 trillion that's being sent into the economy, that they can still afford to pay for it. A lot of those Treasury notes will be put into the Federal Reserve as some of the securities that the Federal Reserve buys during quantitative easing. So what you'll see is them coordinating and working together fairly well. The effectiveness of the 2008 was that they pumped out about $4 trillion. Banks, because they were the target of the quantitative easing because of the mortgage crisis and the mortgage situation, they ended up holding, after that was all done, about $2.7 trillion in excess reserves, which was a little bit troubling and quite an unexpected result of the quantitative easing in 2008. So I believe that the current Federal Reserve leadership is very well aware that they don't want this money going off and being parked somewhere. It does nobody any good if the money goes out and just parks in somebody's savings account or a bank account or in a bank reserve or someplace where it is not used and pushed through the economy. So I'm sure they'll be working through that to make sure that that doesn't happen. So that's kind of a good primer on what quantitative easing is and what this new $2 trillion congressional aid package is. I hope you enjoyed this. If you have any questions, please write it in the comments. I'll try to get to those and answer those. And if you haven't subscribed to the channel yet, please hit the subscribe button and you'll get notified when my next video comes out. Thanks.